This is episode 208 of the Andrew Hines Real Estate Investing Podcast. Welcome to episode 208 of the Andrew Hines Real Estate Investing Podcast. Today I've got Mark Loeffler on the show. Mark comes on usually at least once a year, and we talk about what he's up to as well as what's going on in the market, what his predictions are. Mark and I, for those who don't know, we used to do a lot of YouTube videos on his YouTube channel making predictions and this and that. And it's been a while since we had done one, so I thought it'd be great to give him my take, hear his take, and see how our thoughts might change. And Mark made some good, interesting points today. It's all food for thought at the end of the day. But Mark's also doing some very interesting stuff out in Edmonton using the CMHC MLI Select program to get 50-year amortizations and 4.5% interest rates in this market, which is actually quite favorable, although a year ago it wouldn't have sounded as such. So it was an informative discussion with Mark, and I'm confident you're going to get something out of it if you're interested in knowing what's going on in the market. He's a super knowledgeable guy, and I always appreciate having him on. With that said, and just before we jump into the episode, I'd like to remind you that we talk a lot of terminology on this show, and it's constantly evolving. For those of you who are having trouble with some of the lingo, head right back to episode 1. I used to break things down. I watched a couple of those videos lately. The way I broke things down back then, I included spreadsheets on my YouTube videos. I really did try to simplify it the best I could to teach concepts like debt coverage ratio and leverage, cap rates. If those are things you're struggling with, head back. Trust me, you won't regret it. First 10, 15 episodes really should give you the base foundation you need, and then you can get right up to date, or you can listen all the way through. Many people still do. That's quite the mission at this point, but it just depends on what your appetite for that is. With that said, a couple other reminders. The GTA West REI meetup is still happening monthly. Make sure you're part of the private Facebook group so you don't miss the next event. It's totally free, and it's an opportunity to meet like-minded investors that are doing things. And of course, I'm going to make special mention of the Investing in the US Mastermind for those who are interested in investing in the US. If you head to investingintheus.com, this is an event that both myself and Nick Van Dyke are putting on, and it's going to be a real banger. It's going to be packed with information, and if that's something you're serious about doing, you won't want to miss this event. So now, without further ado, let's jump into episode 208 with Mark Loeffler. Hello and welcome to the Andrew Hines Real Estate Investing Podcast. I've got Mark Loeffler back on the show for our annual video or something like that.
Something like that.
Yeah. Mark, thanks for coming on.
My pleasure. Thanks for having me.
All right, so let's get right into it, Mark. Tell me what's new. I mean, actually, do the quick summary if somebody were to ask you what you do, what's your backstory in real estate, just for anyone who hasn't heard your story.
Geez, quick backstory. Okay, so I've been investing in real estate now for just over 20 years, I think. I started out doing duplexes, triplexes.
In Cornwall?
No, I actually started in Newmarket. Then I went to Toronto.
Yeah.
Then I went to Cornwall.
And then Hamilton.
Yeah. And then I was in Hamilton for a long time.
Yeah.
And now I still own stuff in Hamilton, but I sold a bunch of stuff. Yeah. Recently, I've been buying out in Edmonton.
Yeah.
And I always look for different markets to invest in. I'm not stuck on one spot.
Yeah.
I'm just looking at economic fundamentals and looking to see where I can get the biggest bang for my buck. And I'm super curious about your U.S. investing, because I do want to invest down there. I just think maybe now is not the right time. I think, maybe 6 to 12 months. Personally be more ready. Plus, I think it's going to be a better market.
See, I think almost the inverse, because I think the bigger opportunity is coming in Ontario than Florida and U.S. in general. Because I think, and we're going to dig into this because you're the guy that I wanted to bring on the show to talk about this with.
Yeah.
We'll spitball a little bit on it, but yeah, okay. So continue the backstory. So you've obviously done quite a bit. Edmonton's now the current market.
So we own just a bit over 200 units in Edmonton. We still own, 30 or 40 units in Ontario.
Yeah.
Down from like a couple hundred. And yeah, I mean, I agree. I like Ontario as well. And then I'm obviously a licensed realtor. I help investors sell investment properties in Ontario and now Alberta. I'm licensed in Alberta.
Yeah.
And also what's recently new is I took on 5 coaching clients.
Yeah. That's new to hear from you. I remember you were mentioning that right before we started. So yeah, very cool. And I will say, like, I've known you as the guy that will just adapt to the opportunity. And you've always done that. Like you wrote a book on rent to own, but don't do rent to own.
Yeah, I don't do rent to own anymore. Yeah.
And I remember asking you that way back when. I think when I first met you, I don't even think you were really doing it anymore, which I found funny. I'm like, wow, this like inspired me. And you're like, oh, okay.
Well, you know what? Rent to own is still a great strategy, but it's a strategy to sell, right? To sell your real estate. And a lot of times I don't want to have to be forced to sell in a certain time frame. And I've done all that work to lead up to this.
Right. There were other things you could do. I mean, I think at the end of the day, like we all have a certain amount of bandwidth and you're going to kind of focus on the highest leverage, the highest profit opportunities.
And rent to own is great. Like it was great. It got me started. It allowed me to be full-time in real estate investing for like the first 3 or 4 years. Yeah. And then I obviously got enough outside income to be able to not do rent to own, because rent to own is a lot of work, right? Like it's a lot of upfront work.
It's a lot of upfront work, right? Because you have to qualify the clients, like getting the marketing out there and vetting the clients is obviously the bulk of it. Yeah. Right. And then they find their own house typically, right?
That's
the model
what I was doing. Yeah.
Yeah. Which is good because then they're like emotionally in love with it.
That's correct.
Hopefully they buy it one day and then your hands off. That's the part that's easier though, right?
Yeah, that's the part that's easier.
Because then they're just in there, they're hypothetically doing their own maintenance. The only part that's not easier is when they don't clean up their credit.
Then it's
a nightmare.
Yeah, that's the work. Is you have to be on them to clean up their credit.
Yeah. I've I've been in and around rent to own quite a bit, and I've seen that's kind of the hang up is if the landlord doesn't know how to coach their tenant to improve their credit, then you end up 3-4 years down the road with a very angry tenant. They should be mad at themselves, of course, but they don't take responsibility or accountability.
No, there's no personal responsibility.
Yeah, they're like, you bad landlord, you didn't tell me. Meanwhile, of course they were told, but they don't know how, and there's obviously a lot of hand-holding needed, and it is what it is. So I totally get why you would want to move away from that. I think there are some people out there who do that really well, but it is like you got to be geared to do it.
Yeah, it's more employees, it's more.
Yeah.
Whatever. And it's training those people to actually know what to do too.
Training them. Yeah. And then building that into your price, like when you charge a fee, if you're setting them up and you're selling them, like say JAG does, like you have to build that into the price. We need a credit counseling, mentorship kind of thing.
Exactly.
So, okay. So interesting. You moved away from that. And then obviously Edmonton's, it was an opportunity for you. I saw the same opportunity. It was just a matter of where am I going to focus? I chose US, you chose Edmonton. And tell me about how it's going. Do you still see it as a big opportunity? Are you adjusting in the current climate?
I think it's a great opportunity right now. Like it's one of the only markets I know that like pure MLI Select 50-year amortization mortgages, 95% mortgages work.
Yeah?
Yeah. Like you'll get full evaluation, 95% mortgage.
So that's what you're doing, MLI Select on everything?
MLI Select on everything.
And what's your process? So I think when I first talked to you about this, or when you first came on and talked about this, you just had a couple of buildings you had purchased.
Yeah.
And you were in the process of turning them over.
Yeah.
How has that progressed?
So we've turned over 2 of those right now. We're in a process of getting MLI Select on a third. Mm-hmm. And we're turning over 3 more right now.
Okay. And like number of units you're targeting, like how big are these buildings?
We have everything from 15 to 90 units. So the 15 unit was the first one and the 4th one. And then like the most recent purchase was 90 units.
90 units, okay.
I'm looking at a couple portfolio deals of 6 to 8 buildings. So they might have some smaller stuff in there and some bigger stuff in there as well.
Okay. So this is just somebody you've encountered that has a number of properties they're willing to part with?
Yeah, possible.
Okay. And how much have you seen the market come down out there since the peak in last March-ish?
So, I mean, obviously it's different residential to commercial. I don't think the commercial market's come off that much.
Yeah.
I actually think it's risen out there because MLI Select and rental increases.
Yeah.
Like the rents have gone up there, 10%.
So like what's a 2-bedroom in one of your buildings going for?
So in the renovated building, that's going for like 1,400. And in the unrenovated or not as nice stuff, like we're getting, I think about 1,150 or 1,200.
Okay. And is that where you were buying them at? Like,
no, they were like 900.
900?
Yeah.
But you can just, the lease terms up, you just say, hey, this is a new rent. You don't have to play the games you got to play here in Canada, in Ontario. Like, you can just basically tell them, hey, here's the new rent. You like it? Stay. If not, don't.
100%.
Is there any restriction at all on how much you can change it?
It has to be, you have to make it, what's it called?
like reasonable, or is it?
Yeah, you have to show a business case for it. If like you can't just say it's $1 million.
Yeah,
but
say, hey, this is what I would plan to do with the rent, and this is what I would get. So I need you to pay this or move on.
Yeah, you just so here's a comp over here. This is why I'm charging this rent.
Could you say like, I'm gonna be using this for executive rentals? It's gonna be $3,000 a month. This episode is brought to you by Control and Compound Financial. They are real estate investors assisting other real estate investors to implement the infinite banking strategy. To learn more about how this can help investors like you, visit controlandcompound.com/Andrew Hines. This episode is brought to you by the Investing in the US Mastermind, hosted by myself and Nick Van Dyke. Nick, let's talk about why it's so important to network with other people who are doing what you want to do.
You're the average of the 5 people that you hang around with. So when you go to events like these and you network with people that are wanting to do big things in their life, generate more income, wealth, more time, all that good stuff, when you surround yourself with those people, you just automatically now want to essentially replicate that.
And there's so much that can be accomplished by going to meetups and things like that, and those are all great. But when you focus in on a mastermind, these are people who are willing to invest in their education. They're determined to see an outcome, and it's a like-minded outcome with what you're looking to do. For me, that's huge. I really like nowadays how, you and I are business friends. We're friends. But, it's not like my high school friends where we don't really talk about investing. You and I, we talk about investing when we get together, what we're working on, and it brings us both up. We have a limited number of people that are going to be attending this event. We only have so much space for them. Our hope is that you're going to have an opportunity to speak with everybody who's in attendance, get to know what they're working on. And that's why we're starting early, and we're going right through to a dinner that we're including in the event to give you a chance to actually have those conversations. If you're looking for more information, head to investingintheus.com. Thanks. Now let's get back to the episode. If you could prove that, or are you
I'm sure you could. I've never had anyone fight any of it.
Yeah.
They've just said,
they know that rents change.
Yeah. And then, you don't even need to do an economic eviction out there, because if the lease comes up and you don't want to renew it, you just say, okay, your lease is done. Please
See you
leave.
later.
Yeah.
So there's no auto renewal.
Auto renewal.
But do they assume it? Do they assume it's going month to month, or do they ask you, are we allowed to stay?
No, they ask. They're like, oh, what are we doing? Are we signing a new lease?
Oh, so they want to is that normal out there to just sign new leases?
You sign a new lease every time.
So no one's month to month out there?
No one's month to month.
That's very interesting. I like hearing these unique little differences.
Mm-hmm.
So overall experience, I think Ontario is just so tenant friendly and sort of communist. But anyways, in that regard anyway.
Just a little bit.
Just a little bit. Your take on Alberta, obviously much more conservative.
Much more conservative, much more free market.
Free market, let the market decide. And what's the problem with that? Because you'll see Alberta actually correct down. The rents will correct down.
Yeah.
But not in Ontario, they're not.
No, they're not going to correct down, because we have a systemic problem here.
All these people who are hanging on to low rents in old buildings, they just haven't done proper increases. They're not going to give up their rents, and they're kind of forcing landlords to increase their prices everywhere else.
Well, people aren't just going to build rental properties. So they're not, there's always going to be a shortage.
Yeah.
Sorry, what was the original
question? Just your take on one province versus the other, in terms of a business case for doing rental properties in Alberta versus Ontario.
So, the biggest difference is, and my biggest fear is, that there's not as many regulations. So if there's a huge rental increase, you can just go ahead and build a heck of a lot more property, right? You can put that many more units on the market. So it's really supply and demand.
Yeah. And I think that they're also volatile on the demand side too, because if oil is a big thing, the price goes up, there's more mining and more jobs, and it makes the province boom a bit more.
Yeah. I don't know if it's as much as it was back volatile. In 05, 04, 05, 06, when oil prices were first hit $100 a barrel. It was definitely it was a boom.
It was such a boom, yeah.
You're 18 years old, getting out of high school, you're getting $150,000 job type thing, because they just needed that many people. It's not, they're just not hiring as many people. It's more technological now. Yeah. They've gone back to, they're just not going to drill as much, right? Yeah. They're just not. So it's a little different. But they're still increasing capacity out there and that type of thing. It's
taking
just
on
not
new projects as well.
Yeah, it's just not as at the same steam. So you don't get. I think that's going to level off the boom bust a little bit.
Yeah. Yeah, I mean, it'd be obviously welcome news to anyone investing out there that it wasn't as volatile as it used to be, as oil dependent as it used to be.
Well, I wish it went up 50% last year when I had a couple hundred units. But
yeah, you didn't really get the boom. And that actually is a comfort to me. When I look at a market and I see they didn't really get the boom, in my mind, that means the bust shouldn't be as bad. Now, there's no guarantees, but that's how I feel about it. That's my general take on things. Yeah. Is that your general look at it as well?
My general look, and you know what? They're set to outperform Canada. Alberta, set to lead the country in economic growth over the next 5 years.
Yeah, I mean, it definitely. I mean, on the positive for oil is prices have been generally up, but of course now they're kind of coming back down.
I mean, they have a huge technology sector out there that they're fostering, like just different businesses.
Yeah, diversifying. Yeah,
and they're diversifying. And you know what? A lot of people from Ontario are going out there that aren't working in oil and gas. Yeah,
of course. Yeah,
and it's mainly for, I mean, some of it's for the mountains. I mean, I love the mountains out there.
Same. Yeah. Did you buy a new place in Canmore yet?
I haven't bought a new place in Canmore yet. I gotta figure out some stuff before I do that.
You timed that one perfectly when you sold it, right? You were like right near the top.
I don't. Yeah. And that was just someone came in and said, "Hey, I'll give you a boatload of money for this," and I'm like, okay.
Yeah. When you think opportunity minded, I feel like you attract, good deals come to you. So
yep.
I love hearing stories like that. That's great. So you cashed out. I mean, hypothetically, I think prices are probably down in Canmore a fair bit from
a little bit,
like what, 10% or something, maybe
10, 15, 20%, maybe.
Okay. So just before we jump into sort of looking at the market in general, I wanted to get an idea. So these buildings, you say they work at, an MLI Select program. So what kind of cap rate are you finishing up with on your valuation?
Oh, we're getting like a 5.5 cap.
A 5.5 cap?
Yeah.
Okay, so
5 to 5.5.
And at 5.5, that satisfies their debt coverage ratio?
Yep.
When you're using a 50-year amortization?
Yep.
Because normally that's not going to satisfy, especially not with today's interest rates.
No. And I mean, CMHC interest rates are like 4.5 right now.
Okay, so is that really where you're coming in on MLI Select? Okay, so you're getting like a 4.5. For anyone who doesn't know, MLI Select is a CMHC program. You can get points. So in order for you to get affordability,
access, efficiency, or eco-friendly.
So are you doing affordability to get the 50-year AM?
Yeah.
So a certain number of your units are going to be priced below the market.
Yep.
And they have to stay there.
Yep.
How much below the market?
I think you set the rent when you start, and it's not below the market, by the way. It's based on affordability. So to be affordable in Edmonton, you have to be below, I think it's $1,670 a month. So they have one of the highest per capita incomes.
So then that works no problem.
Yeah.
You can be affordable and still under market rent.
100%. And then you get a certain increase over the years of what you can raise those rents to. So,
okay, so you're restricted in that regard, but the other ones are just free. So what portion of your units are
So if you do a
controlled?
50-year amortization, it's 80%. If you do 45-year, it's 65%.
But you were comfortable doing. Now, do you see a negative to that? Like, is there a potential?
There's definitely a negative. If it does boom like it has and rents double,
but the incomes don't. Yeah. And I don't even know how economies pull that off. I feel like it's just families, like the brother-in-law moves in, like you just end up getting a whole bunch of people living.
No, if somebody moves out, I have to keep that unit under the same.
Yeah, you still have to. That's what I'm saying is like you'll get two families living in one unit.
Yeah.
When we hit because I saw that happen in one of my London rentals, and I'm like, I don't like this.
Yeah.
Because that's how else are they going to afford it? Incomes didn't go up, but rents did.
Yeah.
There's just too much demand. So.
Well, usually if rents go up in Alberta, it means because incomes are going up.
Yeah. Yeah, I mean, well, it's supply and demand, right? I guess Alberta would be the different. Like in Ontario, they're just bringing in too many people. There's so many people here, even though incomes really haven't gone up to match.
Yep.
You have a lot of foreign buyers and stuff. So, which we're going to dig into that a little bit. I'm trying to think if there's anything else we want to cover on the MLI Select program. And what that's doing for you. I'm surprised at 5.5 it still works at 50-year AM. Like, because I've run it on a spreadsheet, and like once you go past like 30 to 35 to 40 years, it starts making a lot less of a difference in your payment. But still worth it to you?
50 makes a difference.
50 makes a difference. Yeah, it keeps it low. Okay. And at the end of the day, you're still on 5-year terms though, right?
Yeah.
That's the only real risk, right? Like, what if in 5 years rates are 10%? You're hoping rents will have come up.
I don't think that's going to happen.
Think so.
But...
Well, we're going to dig into that now then.
Yeah.
Okay, so the other reason, obviously, Mark, I want to have you on is we've talked about markets so much. I've got my take. We haven't talked in a while. You've got your take. Love to hear it. So give me what you got.
Well, it's funny. Somebody commented on my YouTube channel the other day. He's like, why are you still buying?
Yeah.
Like, why are you promoting buying? And I'm like, well, I mean, if we're talking Ontario specifically, I think there's a fundamental problem in real estate here is they don't build enough of it for how many people they're bringing in. Yeah. And they're not bringing in poor people. Like, these are economic, like people who have jobs or businesses or money to be able to buy their way in. So they're people who want to, you know, they're not paying $600. They're not looking for a $600 apartment. They're looking to either buy a house or do whatever. So that's going to obviously, you know, that if there's not supply, then that increases demand. That's going to increase prices.
Yeah, as you would think, right? Like this, they've very much manipulated demand. That's all that's happened. When you manipulate interest rates, you don't take the demand away. You literally soak up all the dollars these people have.
Well, I mean, what you did is you pushed demand forward. Everyone saw that and said, oh, I got to buy now because I got to lock in my cheap interest rate.
Yeah. And
so you push demand from this year, like 2023, back into 2021, 2022, right?
That's so short-sighted. I'd rather pay the higher interest rate on the lower price.
Well, I mean, there's a whole bunch of people out there on Instagram doing the math right now. If you bought it then at the peak to now, what you'd be paying. But I like to do year over year, and I think you're still better off if you bought. Well, no, because we're getting into that time where it's peak to trough now.
Yeah.
Or peak to now.
Yeah.
Who knows if it's the trough? But yeah, like, and it's getting cheaper to own it now, like monthly and down payment wise.
Yeah. Cheaper now, even though we're paying much more. Yeah, and I'm more thinking for the long term. Like, if we had 30-year mortgages like they do in the States, it wouldn't matter. Go ahead, buy the property for, you know, and this is not advice, but in my mind, you know, a few $100,000 more to lock in at a 2% would actually be worth it when you keep that 2% for 30 years.
Yep.
I mean, the people that locked in 2021 at like 2.25% in the States, I saw all kinds of memes about this. I thought it was hilarious, but like, they're just laughing. Like, well, you don't need to sell.
Here's the biggest thing about the States is you can break that mortgage at any time without penalty.
Yeah, so if you had much more favorable.
If you had a 4% mortgage, you're just like, oh, never mind. I'm going to go get a 2% mortgage, again, brand new mortgage.
Yeah.
And re-amortize over 30 years. And
yeah, it's actually insane.
Or 15 or whatever, but yeah.
I'm not sure if I've mentioned this on the podcast before, but I was talking to a guy, because I obviously speak to several Americans now that I'm investing down there, and I explained what we do with our mortgages there. He's like, that's absolutely insane.
Yeah.
He's like, what's going to happen after 5 years? Well, we just renew at the market rate. Are you kidding me? So you don't know? Like, they're actually really put off by it.
Oh, yeah.
Yeah.
Well, that's why all the arms and everything they had, like back in 08, 07, 06, 07, 08, that's what threw them, right? Like,
yeah. They must have been getting a killer deal back then.
They weren't. They were just...
On the arms? Why take an arm when you could lock a fixed in for 30 years and break it at any time?
They didn't qualify, right? Those were the ninja loans and stuff. So
yeah. That's...
And the teaser rates were good for 6 months to a year.
Yeah.
And then if you could refinance and do another teaser rate, you're just like, oh, because you didn't have a penalty.
Right. So you could just keep rolling it into new mortgages. And I mean, kind of bad for the banks there, but, you know, good for the people. And so this is why my take on the US is they're going to feel it a lot less. Where in 08, they felt it a lot more. The 30-year mortgages are now going to save a lot of people because now they don't need to sell. Whereas you look at Canada, people are renewing into triple the rate.
Yeah.
All of a sudden, their payment is now unaffordable. And now they're thinking, maybe we'll list. That changes things.
Yeah, you might be right. I go more that I'm looking more like the political troubles that are down there, and like how took 15 tries to elect the Speaker of the House.
Yeah.
And it takes one usually, and they have the debt ceiling coming up in August. So I think that there's a very real chance, better than 50% chance, that they could default on their debt in August.
Well, what's the historical precedent for them defaulting on their debt?
Never happened. So why would it happen now? Whole different system, whole different mechanism. Like they've never gone to 15 votes for a Speaker of the House.
Yeah. So they're just divided.
It's always been one. You have a couple of like hardcore Republicans that are like, hey, you want us to vote?
Yeah,
we'll vote, but we need this.
Yeah.
And they basically want
so they have a standoff.
they want domestic spending cuts.
Yeah.
Medicare.
Yeah.
I don't know if it's
Are they going to repeal all these massive unibus bills that went through? I mean, who knows, right? Like nothing's ever going to get through because the Senate's still, Democrat. So it's just a whole bunch of nothing getting accomplished.
Well, that's it. That's why I think there's a better than 50% chance that they default on their debt.
Okay, so let's unpack that. What happens in that scenario? Aren't all the Congress people not getting paid?
Yep.
All right. Well, that'll be an interesting year.
But let's be honest, like they probably make more outside of Congress than they do inside. So.
100%. Nancy Pelosi became like worth what, 200 plus million on a $200,000 a year salary. Like it's all favors.
Oh, 100%. So
I find it humorous when I really unpack what politics actually is. I'm like, and people don't get mad about this. And I think most are just too into their lives, their daily lives to.
Well, it's so funny. I had a conversation this morning, and he's a pretty wealthy individual, and was basically said, these politicians, I've seen them on their hands and knees begging for money.
Yeah.
And when you get that, like, he's like, are they really doing what's best for their constituents and their country?
Yeah.
Or are they doing what's best for them? Because you don't get smart people doing it, right?
It's always the latter. I mean, if you want to be a politician, you want it to be a politician. Like, you'll know when you see somebody who's not a politician getting into things. Trump, for instance, not a politician.
Yeah.
Just played the game. I think very ego-driven. Like, I'm not saying he did some good things, and he's also a bit of an idiot too. So, but that's my take anyway. But like, you just don't see it. Like, why would a guy like you or I want to get into that?
No, never happens.
Circus.
Yeah,
it's a circus. But yeah, I think it's very much the latter. They do what's good for them. I think the party system causes people to capitulate to what the party wants versus what their constituents want. I've always thought this, well, not always, but for like probably the last 5-6 years, I've been very much, why do we have parties? We should have no parties. People should actually just get in based on their own merits, not the color they wear on their shoulder.
Yeah.
And we would have a very different system if that was the case.
We would.
Because then they would actually have to listen to their constituents and what they want.
Yeah.
So,
well,
even things more work. But
even in our system, it doesn't matter. Like, you vote whatever, and then it's the prime minister and their office dictating what you're doing.
Yeah, exactly. Because if you don't vote with your party, you get maybe 1 or 2 passes, and then all of a sudden, hey, we're gonna have a problem here if we don't start seeing you vote yay.
Yep.
Yeah. So, not to go down that road. But
because they all want the anyway, it's true. We could
not that I don't mind going. I mean, I think it's a valuable discussion. Like, if we're real about what's actually going to happen, like, Canadian government isn't going to be doing investors any favors, but there will be opportunity in what they do.
There's always opportunity, right?
Yeah, like the MLI Select program is a huge opportunity. That's sort of, it's government sponsored ultimately. Yeah. CMHC is government corporation, so there's a benefit. You took advantage of it.
Yep.
So, but obviously, as economic troubles continue, I heard and I won't give his name because it'll be up to him if he wants to share this on the show when he comes on. But one of the investors I was speaking with, he has many, like hundreds of doors here in Canada, and he's actually in single family houses, and he's shifting away from them. And his thought is, the mortgage issue too. He was big on that, the 5-year mortgages, but also Canada is not nearly as friendly to the entrepreneur, right? Like when you have a landlord here, we have, tenants actually think landlords are the bad guy. Even small landlords who just have a couple of rental properties, big bad landlord.
Yep.
That mentality, he says he's found many cities in the States where he doesn't see that.
Yeah.
And he feels a lot more comfortable because he's like, one day they're going to scapegoat on the small landlord, and it's not going to be fun.
Yep.
So just a thought. I mean, I don't know if that plays out or not, but it's an interesting perspective.
I think they already have.
It's already happened. You're seeing hints of it for sure.
I mean, I think it's interesting. We're seeing that lawsuit against the landlord-tenant board right now. I've just been waiting for it.
Yeah.
Like I've said this. Somebody has to sue them. Like, this is.
Yeah.
It's unconstitutional. It's fraud. It's criminal. What they're doing, right? So.
The constitutional part of. And I mean, maybe you have a take on this or not, but I heard that, the provinces were in charge of personal property. So I went and read through it, the division of power in the Constitution. It just basically says that they can do it.
Yeah.
They can regulate, property. So what's their angle if they're suing them? Is it like a charter?
2 years getting somebody out. So it's just economic.
Yeah.
It's like, you've caused me economic harm. I've had damages.
So they're just straight up saying you're like a simple civil suit. You're causing me harm.
They have to. Yeah. I mean, that's the only thing that.
And what's the status of that right now?
I don't know. I've just saw that it got filed or whatever. And
interesting.
So it'd take years to get through the courts. And
there's an interesting one that no one ever talks about, and this is not legal advice. This is just for discussion. So the Bill of Rights 1960 actually explicitly says we have the right to enjoyment of property, but the Charter doesn't. And the Charter allows a massive out. Like if the government reasonably thinks they should, then they can just take away your rights. Whereas the Bill of Rights didn't do that. If you talk in general state and in settings, like people will say, Bill of Rights, that's old. Don't use that. Use the Charter. I think we should be seeing more people using the Bill of Rights. Can you imagine the arguments you could make? Well, how can I enjoy my property if you're taxing it? Yeah. Should I not have said that on the podcast? I feel like that's the type of thing you really shouldn't say on a podcast.
Listen, as long as your taxes are up to date, I'm sure you can say whatever you want, right? It's a free speech, technically.
Yeah, technically something like that. So, Mark, what's your take then? So you think that the U.S. maybe will default. What does that do to the environment there? I mean, politicians aren't getting paid. That's not fun.
Yeah, I mean, anytime it causes uncertainty, it's not good for the markets, right? Yeah. It won't be good for the stock market. When the stock market goes down, there's less money to invest in real estate. So you'll see less people buying. You get flight to safe haven. Mm-hmm.
So it'll just affect all the markets.
It'll affect all markets there. Mm-hmm. So
that's where you think the opportunity will be. If there's panic in the short run, I mean, of course, these things get resolved. The idea that government won't get funding.
I think that type of incident will have larger repercussions. It'll take a year
to correct,
year and a half to really filter its way through the whole system. Maybe 2 years.
At the end of the day, these guys are all paid by the same people. They all just want to get paid at the end of the day, right? If they're at risk of getting voted out, they'll do what it takes to not get voted out. But
there are, I don't know, you only need 4 or 5 people really to jam up the process, and they got those. And it's if you don't care.
Yeah, if you don't care,
I don't care about the money. This is what I'm doing because I think it's right.
I haven't seen that in a politician. That's interesting.
Well, they care about the money and they're getting paid outside maybe.
Yeah.
But they don't care about their salary.
Yeah, I haven't followed it too closely, and by the time this airs, this is a little bit old news. But I know Matt Gaetz was taking a stand. Did he end up stepping down? He's still.
I don't know.
Oh yeah, he's one of the Florida Congress people.
Oh.
Yeah. Anyways, one of the people standing off why they were having such a hard time because they're so split. But hey, if anything, I think that's a good thing if it makes people start talking and being real about things. I'm not overly optimistic. I think we got to make our own solutions. But
yeah. I think definitely we're going to be in a recession probably by the time this airs. When is this going to air?
A couple weeks, 2-3 weeks.
Okay, so maybe not by that time, but I think you'll see that we had Canada in general had a negative quarter in the fourth quarter of 2022.
Is that our first negative growth quarter?
Mm-hmm.
Yeah.
And then we'll just need a second one in the first quarter, which I think we'll get.
Unless they change the definition, then
I don't think they're going to do that. But interest rates, I think we're going to see another quarter point rise in January and probably another one in March. Mm-hmm. I think that's going to stop at that point. But if we see a recession, long-term bond rates will go down. So that means I'll get my mortgages cheaper.
Yeah. So even if they change the overnight rate, and I just broke this down on REI Hot Seat. If people want to understand the difference between these two, go check out the episode from the first one in January. But basically, you could still have your fixed coming down with the exception of the fact that they're doing quantitative tightening. They're selling off bonds trying to drive the price down.
Yeah.
Now, I don't know how many more they have to sell or what their level is right now, but I did hear that they recorded a loss. I guess
first time ever.
Yeah, so they did record a loss, which makes sense if they're selling off bonds under price.
Yeah.
Or just to drive the prices down. So hypothetically, if the market was allowed to function as it should, people would adjust and those bond rates would probably come down. Can you unpack that a bit more, why they would come down? Just the uncertainty in the market, basically?
Yeah, just the uncertainty of the market.
These bonds, aren't they typically, especially government bonds, safe haven?
Yeah.
They're considered that, right?
Well, that's why. So more money flows into there from outside.
Right. So then the demand for those goes up, which is why rates go down. There you go. Yeah. So obviously that's a factor to consider.
Plus they figure long-term bond rates are if we're in a recession, they're going to lower short-term too at some point.
You'd think.
But I don't think we're going to see a lowering in 2023. We're going to see an increase, maybe 1-2 minimum.
Yeah.
And then we won't see it. Like they'll hold it steady through 2023.
Well, we used to do our prediction videos and it was like, are they going to do it? Are we going to see growth in 2022? I remember we were predicting that at the beginning of the year. And we both naively thought, well, yeah, like, 10% up. Because we didn't think it could continue.
Well, you were higher than I was.
But I
was a little...
My thought process was they couldn't possibly raise interest rates with the amount of debt people have. Their sentiment, like I just didn't think they'd do it. They'd be as ruthless as you'd need to be to control what is actually over 10% inflation if you didn't do the substitution that they do in the CPI. So I just didn't think they would do it. It would take because I knew it would break Canadians. Now it turns out that this Tiff Macklem guy changed his tune from we won't even increase rates until like end of 2023. So don't you
full
worry.
Employment. Which was the stupidest thing he ever said.
Yeah.
They should have been increasing rates like 2021.
Yeah, right.
July.
And now he's like, I'll settle for nothing less than 2% inflation.
Yeah.
But here's the other side of that. I mean, when did the big inflation really start? About a year ago at this point?
April
2021?
2022.
No, it was bigger than that.
Oh, it was bigger, but we didn't see it. Like it
didn't peak until
it was like 4 or 5,
yeah,
and then it went to like 8 or 9, and
it kept going
April.
up. Yeah.
So yeah, I agree. We're going to see year-over-year prices.
Year-over-years are going to start declining. So
we're already seeing that, right? So
it's coming down. Yeah. So if he says 2%, effectively we are going to look like 2%. I think a lot sooner than people think. I think that, and Michael Burry had a tweet, which I thought it was a softening. If anyone follows Michael Burry, the guy that predicted the whole 2008 thing, he's been very much doomsday about a lot of this. And then he sort of softened up on it. And he's like, look, it makes sense. We're going to see CPI actually probably even go negative in the first, quarter or second quarter of this year. He's like, then they're going to lower rates and then assets are going to inflate even more. We're going to do it all over again. Will they? I don't know. But keeping that in mind, maybe make decisions based on some of that information or factor that into your information. What do you think? Like, do you think we'll see it go negative?
I don't think we'll see it go negative.
But come back down into the 2% territory?
I think we're going to be sub 4 this year.
For inflation. Yeah, I think that's very, very likely.
Yeah, I think sub 4. I don't think we hit 2%. That's why I don't think we see a decrease in rates.
But look at the historical precedent. We never saw a decrease in rate when inflation happened in the 80s. Like it took forever. Like they hung tight in a very high territory.
I think it's a bit different about how the inflation came through and what it was and all that type of thing.
But to see a quick drop in rates,
I don't think we're going to see a quick drop.
I mean, if it was like the 80s, it took from like 85 to 2000 to get back down to 6%. Like it was a very steady sort of decline from like high teens.
Well, I remember my first mortgage was like 6.35, and then I had a 7% mortgage in Toronto, and
right around 2000, right?
Yeah, 2002, 2000. Yeah.
Yeah, and that's where we were. And then it kind of hung out in that territory up until 2008, and that was the new era of 2-3% rates, which didn't exist before. Do you think we ever go back there?
2-3. I mean, I think we see 3 again. At some point, 3 to 4. I don't think we get to 2s again.
Yeah.
I think that was them flooding the market with cheap debt, buying bonds, buying that's
trying to stimulate a market that they artificially closed. It made no sense.
Yeah.
So ultimately what they did is they gave people a lot of money to spend on Amazon and a lot of savings.
Yeah.
And then everything opens back up, and exactly what a lot of people predicted is now the spending will flow and it will cause the problems that it has.
Just as long as everyone keeps going to my restaurants.
Just as long. Caro,
Victoria's, and now the new Speakeasy. My father was famous.
That's all in Hamilton?
All in Hamilton, yeah. Make sure you go eat.
A restaurant entrepreneur. Yeah. Hey, we haven't even talked about that. So, tell me how that's going. Why restaurants? What about that makes you want to do that?
So why restaurants? I never wanted to get into them. I had a property that we had a commercial space in, found a guy. I'm like, hey, you should open your own restaurants. He's like, I don't have the money to renovate. I'm like, we're renovating the whole building anyways. So why don't we renovate? We'll give you a loan plus equity. Or we'll give you a loan. You give us some equity and you pay us back through sales. And then it's just turned into 4 places now and possibly a 5th.
So it wasn't an intended JV and it ended up being one?
Yeah.
So you don't actually run these. What's your level of involvement other than an equity partner?
Other than I'm an equity partner and I tell people to eat there and I eat there myself.
Yeah.
That's my only job, is to come on stuff like this and say, hey, go eat there because it's really good food. And yeah.
Now, restaurants are typically seen to be like, I mean, at least in my head, pretty tough business.
Yeah. Yeah. They're not, everything was going great. COVID obviously
hurt
kicked
things,
the shit out of us. But we're doing a lot better now. Everything's
people are coming out to eat. Yeah.
People want to eat. People want to be out.
Yeah.
Like Cops Coliseum, because one of our restaurants is close to there. Like once that started doing events again, that really, really helped us.
Drove things, yeah.
But no, it's not even Cops. It's like First Ontario.
Yeah, they've changed it. First Ontario Place now, yeah. But I still think of it as that too, Cops Coliseum.
But yeah, I mean, with more people going out, hopefully that just continues. Like I worry a little bit about the steakhouse because it's a little higher end.
Yeah.
The pizza pasta places, I think, will always do well through the recession just because it's affordably priced. Like you're 25 to 30 bucks a head with a drink, right? So for dinner.
Really going to see how habits work. Like, you hear this in theory, in a recession, here's how people behave. And I just never, I think, was mentally mature enough to pay attention. We're going to see a lot, I think, in the next.
It's funny though, right? It depends. Like you look at it and say, okay, people don't change their habits in a recession. They only change their habits if they have a life, something happens in their life. Like if they lose their job.
Yeah.
Or
it's not the recession in general that makes it happen.
Not the recession in general. So like people who have jobs during a recession are typically going out and doing whatever they're going to do if they're not fearful for losing their job.
There's some people though that are going to say, oh, our pension's way down. Like we need to save a bit more this year.
Like I sat down with my parents the other day and they're like, yeah, we got a 5 or 6% boost in our pension from Bell, and so we're getting more money. And so obviously it's not all people in the same story. Mm-hmm.
I've been thinking about this a lot for our camp. Is like we're like a discount vacation. Like if you were going to go to Greece, you could just go to the grotto up in because
it's the same Greece, the grotto.
So I mean, it's grotto is Italy though, isn't it? Yeah, grotto's Italy anyways. But we have a grotto here too. But if you were thinking about one of those vacations, like you got a discount version. And Ontario, I think, is actually very beautiful. So I mean, that's at least how we're gonna position ourselves. And I think we already are positioned as, hey, like it's a pretty awesome experience and it's affordable. And I think that people who are going to be successful in the recession are going to steer into solutions that people in a recession want, right? You've got your lower price restaurant. People still want to go out. Maybe they don't get steak, but there's still going to be people who want steak.
There's still going to be, I think we're going to do okay. Like, we're pretty established. And
yeah, of course. And there's so many other factors that can drive business. Like you look at a generality and you say all things equal, this is going to have this effect. Well, don't let all things be equal.
Yeah.
Just adjust your marketing, adjust your approach, talk to people. Like you could have the best year ever.
Yeah.
I think a lot of people forget that in a recession, that you could still have the best year you've ever had in a recession.
Yeah, for sure.
And it's just up to you to make it.
I usually have better years in real estate because if I work with investors, in a recession, people are picking up stuff if they're not fearful. Right now, they're a little fearful. But,
what's your take on the sentiment in general? Like I know a lot of people have been sitting on the fence, but there are still people buying. Like I talked to Jake, he does a lot of multifamily commercial, and people are still snapping that stuff up. Yeah,
well, there's so little inventory in Canada or in Ontario.
Yeah,
like I mean, I've done 3 deals in the last month in Alberta for multifamilies. I did one here not too long ago, and same thing, right? Like it's because they're looking at it and saying, okay, I'm buying it at $800 a month rents. Market rents are $1,800 right now. And by the time I get those people out, it'll be $2,000.
Yeah.
So I'm banking on that. Like the systemic problem in Ontario is that there's not enough of these. Therefore, if I buy this, it'll be good in the long run.
Yeah. And they've created such a problem in Ontario, and now the new starts are way down. Like developers, they don't want the uncertainty. They want to wait until they know where the prices are headed. They'll probably wait until things come down.
And to be honest with you, if the Ontario government was, I mean, it doesn't matter what government's in, but if anybody had the foresight to say, okay, we're going to be able to make this rule about new developers, and they would switch from condos to rentals in a heartbeat. But it's just the uncertainty, right? Like if the current government can make all the rules they want, but in 4 years or 3 years or whenever, if they get voted out, that rule can change.
Yeah, exactly.
And so like developers are like, I'll just sit on my money.
Yeah, and wait.
I'll just sit and wait. Like it's not worth the risk of another different government coming in
and getting in the way of the free market, right?
And changing the rules on me.
Yeah, I think the market is far more predictable than government. If it was really just up to the market.
There is still that nervousness in Alberta, is that like, oh, does like NDP get back in? Because there's a fragmented...
They were there not too long ago, right?
Not too long ago, because the Conservative Party fragmented out there.
Yeah.
They got back together, and that's why they won the election again, but that's what happened, right? Like,
that's hard to imagine in Alberta. Probably less of a concern out there, though, because the people in general in Alberta, it's still, more minded that way.
It is. It's just the hardcore versus the fiscal conservative, but progressive, whatever, right? So progressive conservative.
Yeah, well, so here in Ontario, obviously, immigration is affecting Ontario probably the most significantly of any province, because Justin Trudeau decides how many people are coming in, and they all seem to want to come here.
Well, here, Vancouver, a little bit Montreal. Alberta's getting proportionately a large portion. Yeah. But like, you got to figure, like, Calgary and Edmonton are only about 1 million people.
Yeah.
So, to like Southwestern Ontario is 10 million people. Mm-hmm. So for Southwestern Ontario to absorb 200,000 people, it's a lot less than, it's like Alberta absorbing 20 or 40,000, right? So...
Yeah, like here's the case for Ontario. I mean, isn't this the scenario that every investor wants? Prices are down like, 30%, 25, 30%?
35 on some.
Yeah, some places. And rents are up like 40% in the same time frame.
Yeah.
30%, like depending on where. Like I know London, it was year over year, it was like 37% in November.
Yeah.
Like that's insane.
That's insane.
Like, isn't that the scenario to buy? And that's not to say that there isn't further to come down.
Well, rents will go up in the recession here for sure.
Yeah.
Because more people will rent, less people will buy.
Because everybody's uncertain. And so that's the argument if you ask typically, like, when do you want to buy? When rents are high and prices are low? Yeah. So that's the argument. That's why there are people buying right now.
That's why there's people buying multifamily right now.
Yeah, buying multis. I think, like you said, I agree with you very much so. The residential single-family homes have been hit worse than the multis, and it makes sense because multis are far more driven by income, except for the small multis where people realize, hey, I could just buy a house and make that triplex.
Yeah. I mean, the larger multis obviously didn't have the price increase that the single families did last year. Like,
no, they didn't go up as much.
They didn't go up as much. So they're not going to come down as much. They're down a little bit.
Yeah. Yeah, they've definitely come down, but people are still buying.
Mm-hmm.
So what's your angle now then? So what would you focus on investing in now with the market the way it is? Is it still Edmonton? I know you said you're interested in the States. Great time to learn now. Head up to a mastermind and,
March 4th, I think it is.
Yeah, immerse yourself.
I may or may not be there. I'm not 100% sure.
So we're trying to nail that down. Mark will do his best.
So what am I doing right now? I'm still looking in Ontario for multifamilies. If I find the right one, I'll buy it. But majority of that's going to be Edmonton. Mm-hmm. I'm working on a couple larger deals out there that I'm going to pick up. Mm-hmm. Hopefully, if the numbers
larger
work.
is 100 plus.
Yeah, like portfolios of like 6 to 8 buildings, like 100, 200 door type things.
And that's still the same model you were talking about before, where you're bringing in investors as the equity. And what do you do? Like a preferred?
We were doing preferred, but I think we're just going to go back to the old 50-50.
So it's just 50-50 straight through.
50-50 straight through, one investor per deal, maybe two.
Yeah.
Just keep it simple.
And so these are people coming in with $1 million plus to close a deal. Plus renovation funds. Like, are you funding the renovation with like a small credit union, or are you doing it with?
So we have private money that will do the renovation. We can do it one of two ways, but I prefer to just bring the cash in. Yeah. With the renovation and everything. So. And
what's your team look like out there?
Yeah, we have a great property manager that we use, and then we have a couple different contractors out there, and then obviously we have a mortgage broker. I'm the realtor, so.
Yeah, you're licensed out there now, right? Yep. Sharon did that too?
No, she's not yet licensed out there yet. No.
She was saying she was going to.
Yeah.
Yeah, so Sharon hasn't been on the show yet. She should actually, so Sharon and you sort of built the team together, Katana Loffler team, and you're investing together as well. Yep. Yeah. How do you find that you two work together in that? Like, what's she handling versus you?
She's handling like investor relations and relations in general, like, so I don't have to talk to people. That's
Wait, you don't like talking to people?
I you know, I actually don't mind it. But at the end of the day, that's her specialty. So let her run with that. And I'm more like the operations. And
so operations, you're just coordinating with the various different people on your team on the daily, or do you have somebody there that sort of GCs?
We have a GC down there too. So
it's a general contractor GCing all your rentals, just subbed out, right?
Yep.
And then your property manager, like, how much do you empower your property managers to make decisions?
100%. I get phone calls from them, obviously.
Like if it's going to be a multi-$1,000, fix, do you get, clear it with me first?
So we have WhatsApp group. It'll get put in the WhatsApp group. Hey, the guys, this is going on. And we're like, oh, if I get it, fix it. Like that's,
Yeah, usually that's my sentiment as well. Like people on site contact me. I'm like, well, what are we going to do if we don't fix it?
Yeah.
We're going to have to fix it. So, but yeah, I find like when you give those rhetorical responses to people, they start to make the decisions more themselves. Oh, I get it. I know what Mark's going to say. So I'll just do it and apologize if he gets mad.
Yeah.
And that's, you'll find it's very rare, right? Like Rod on my sites for construction, like he very rarely will make a decision that I don't agree with.
Yeah.
If it did happen, it's more if he missed something, but not if he like said, hey, I saw this problem and fixed it. I'm rarely mad about that.
Yeah.
Yeah. And do you think, I think that's a fear some people have. It's like, oh, I'll get called for all these little things. Not if you empower your team to make decisions.
Yeah. Well, we do. And they know that. It's mainly, hey, here's a heads up.
Yeah. Here's a heads up. We did this. Yeah, that makes sense. I like that approach.
Or, hey, we have this and it's going to be more than we think.
Okay.
Yeah. Well, we still have to do it. So
time-wise in your week, what's the split usually when you're not running marathons and training and all that?
Yeah, I'm probably a quarter of my time on my investing business, quarter of my time with team, quarter of my time like coaching.
Yeah.
And then I got some more time, so that's why I'm going to actually take on some clients this year and help them buy. Nice.
Yeah. Yeah. So you're like probably 30 hours a week, kind of like obligations now, if that.
20-ish.
Yeah, 20-ish. Well, you don't want to be just busy, right? Like I think like if you give yourself a little bit of like breathing room in there, you have time to think. And then that thinking time results in much more money because you think strategically about what you need to do.
Exactly.
Yeah, I like that approach. And all your bookkeeping for all these projects, all your accounting, like obviously you have a great accounting team. Like is your bookkeeping internal? Do you have subcontractors?
No, we're outsourced. So
yeah. Do you have somebody like, I know Sharon, obviously, I've gone out to dinner with you guys. She grabs that and so you just make sure it gets off to the right person.
To the right person.
And they handle everything. Like what's your involvement at that at the end of the year?
So we have a monthly call. Hey, what happened here? What's this?
Okay, so you just go over everything and then
where does this go?
They give you the reports and you take a quick look.
Yep.
Yeah. I'm always, that's something I'm starting to ask more is like, how do people do this? Especially when you have a lot going on because you don't want to get into the micro.
Yeah.
And you want to make sure your books are being done regularly. So you don't hear in 6 months that, hey, what's this?
Yeah.
You'll never remember.
No. Like there was one, and we had a new bookkeeper take over and this wasn't filed from a year ago and $70,000. I'm like,
how does that not get filed?
I'm like, I don't know what that is. And then it took, I don't know, 3 people digging for like an hour to figure it out. Oh, there, that's what that was. Yeah,
that's the worst. Get a good team. We've got, for our camp, we got a really good bookkeeper. He's actually in Philippines and he crushes it for us. We just got a system down. It took some time to get it ironed out, but once you get those systems in place, it works really well.
I think a lot of people get frustrated with the starting it.
Yeah.
And then they give up in the start, right?
Yeah.
Like they don't see through it and say, okay, there's going to be hiccups to start with. Mm-hmm. And it's going to be annoying to start with probably. But once this all goes, it's easy.
Yeah. Yeah, you have to put in the work to set up the systems. Mm-hmm. But then things could be really cool.
Yeah.
Just, it is daunting, but sometimes you just got to push yourself when you're not comfortable.
Yeah.
You got the concerns. Anyways, Mark, where do people find you, reach you, follow you?
Hit me up on YouTube, the Mark Loeffler Experience, or Instagram, Living the Dream 40. Probably going to change that actually just to be Mark Loeffler or whatever, because I think it's time, but...
it might be time.
Yeah.
But I think they find you if they type in your name anyway.
Just Google Mark Loeffler and you'll get that.
Them. Okay. And any words of wisdom in this climate? What you want to share with people?
I don't know. Go buy good deals.
Go buy good deals. Yeah. Don't forget there are good deals.
Put offers in. Who cares?
Yeah, exactly. It doesn't hurt to make an offer.
Yep.
So. Cool. Cool. All right, Mark, thanks for coming over. Appreciate it.
My pleasure. As
See
always.
you next time.
All right.
Thanks for tuning in to today's episode. Please make sure to share this episode far and wide. Help it help more people. I really appreciate you tuning in. I'll see you on the next one. There are a lot of people out there talking about the infinite banking strategy and whether or not it makes sense for them. To find out what it's all about and if it's a fit for you, visit controlandcompound.com/Andrew Hines, where my audience can gain exclusive access to books, podcasts, and webinars tailor-made for real estate investors. Are you interested in getting started in investing in the United States but not sure where to start? Why not attend the Investing in the US Mastermind hosted by myself and Nick Van Dyke on March 4th, 2023. Nick and I will be covering topics ranging from A to Z, new construction, multifamily development, Airbnb, and much, much more, as well as the basics, including opening a bank account and understanding the proper corporate structure. We'll have several keynote speakers touching on very specific topics. And most importantly, you'll be sitting in a room with people who are highly focused and highly committed to investing in the United States. For more information, visit investingintheus.com and send me a DM on Instagram for a special discount code. I'll look forward to seeing you at the event.